Hello, everybody, and welcome back. Today, my guest is Robert Horrocks. Robert is the Chief Investment Officer at Matthews Asia. Welcome, Robert.
Oh, I'm glad to be here.
Robert, today we want to discuss recent developments in China. U or L-shaped recovery. Economists all over the world are arguing about how global economy is recovering. What is the situation 9 months after the breakout of COVID-19 in China?
Well, it's a V in China, for sure. We've already seen a lot of the important macroeconomic indicators come back quite strongly. And the reason why it's a V is that they've been very successful in controlling the spread and the outbreak of the virus in the first place. They're more used to these, and so they were better prepared. And the second is they haven't had a very strong stimulus in China. So the bounce back has not been dependent upon stimulus checks. And the reason why people around the world are arguing is because it's very different in different economies. The US, for example, looks like it's going to be a much longer drawn out L shape, if you like, that is dependent upon stimulus checks that were sent out by the government. So I think in China, we're already through the worst. The US still has a way to go, and there's a question about how long that stimulus will remain. And the rest of the world seems to be getting back on its feet a little bit quicker than the US.
Stock markets have returned to near pre-COVID-19 levels. On the other hand, earnings have fallen. That means valuations of stocks have risen. What is your current assessment of a current stock market valuation level?
It's a great question about valuations. And if you look just on the superficial headline numbers, it looks really quite expensive. But you're right when you say that earnings have collapsed in a lot of these companies. And what's been great about the market is its willingness to look through that. So you really have to look at those forward earnings. What are earnings going to be like in 2021, 2022? And then valuations don't look so bad. The other thing that is supporting valuations in some countries are the very low bond yields. So you have to ask yourself, how robust are these valuations given where bond yields are and given where the recovery in earnings is? Now, here's a slight worry for places like the US, where bond yields are extremely low, at record lows. And the likelihood is at some point that they're going to come back up, and that will harm valuations. Plus, the length of the US recovery means that earnings might disappoint. Whereas in China, where yields are back to where they were pre-crisis and the economy is already recovering, valuations seem to be a lot less fragile there. So when I look across the world, I see better headline valuations in China and Asia than comparable countries, and those valuations seem a lot less vulnerable to potential changes in the macroeconomic environment.
Especially Chinese technology stocks, let's name Alibaba or Tencent, have become very dominant in many fund portfolios due to the sharp rise of their stock prices. Is there still some upside left for Chinese technology stocks?
I think Chinese technology stocks are very interesting. And the reason why they're so interesting is that they predominantly serve the domestic economy. And so the first thing to say is that it is, sensible to have exposure to these stocks, even if you have exposure to the large US and European technology stocks, because they all serve their own domestic economies. I would say, though, better perhaps to stick with some of the more established ones. One of the things that we've seen recently, certainly with some of the US listed ADRs in some of the marginal technology stocks, is a lot of those stimulus checks in the US were actually saved, particularly for the higher incomes. And there's a lot of day trading go on. So there's extremely frothy behavior, very speculative behavior in some of these marginal stocks, stocks of businesses that don't really have any profits yet. So some of those valuations look a little extreme, but if you stick with the established names that are dominant in their domestic economies, yes, they still look reasonably valued to me.
So the conflict between US and China has been escalating, and it seems as the US government is totally fixated on damaging Huawei. So why is it?
Yes, Huawei is an interesting company for the US to fixate on. It is a large, privately owned business in China, but with links to government. So there's that national security concern. But I don't think that's the real reason. I think actually the real reason is a lot more deep-seated psychological. I think they're starting to see the Chinese innovation and technology almost at a par with what is being produced in the US. And Huawei's been important because China has done a lot in the telecommunications sector. But you're also seeing it now in the healthcare sector. And so you're seeing the US government turn its attention to some of these businesses. Now they're wondering about whether Chinese students should be allowed to come to the US. Now, this is all about trying to protect the global position of some US multinationals rather than any real national security concern, particularly when you see the US talking about healthcare companies. Well, if we get better health solutions across the world, how is that not ultimately a benefit to everybody? So I don't think this is really about national security first and foremost. I think this is about trying to protect some of the US multinationals from competition. Competition that is just being hinted at now, but might become quite severe 10 years down the line.
So currently we can read a lot about technological decoupling. So how is this a possible scenario, and how likely is this scenario? And who has the better trump cards in this game, the US or China?
Yeah, I'm always skeptical about decoupling, particularly when it comes to issues like technology decoupling, because the truth of the matter is the greatest benefit that we get from innovation and from technology doesn't come from the original idea itself, and may not be won by the person who comes up with that idea. The greatest benefit we get from innovation and technology is how that idea spreads, how it is used to make production more efficient. And so ultimately the benefit accrues to the consumer. So I don't think it's really true that you can have a global technological decoupling, because people will see what you're doing and will try to mimic that and try to do the same thing. And that's a good thing for everybody. What you will see, however, is because of reasons of regulation, language, culture, infrastructure, these kinds of things, that there will be domestic champions that grow up in each country. And I think, identifying those and holding on to those is a sensible investment strategy.
What can we expect for the China-US relationship after the US elections and the two possible outcomes?
Yes, it's interesting, isn't it? China-US relations, both the Democrats and the Republicans seem fearful of China. I think this is just the feeling that they're emerging as an economic superpower. I don't think they have desires to be a military superpower. So whatever happens, there's always going to be a friction between the US and China. It's just a natural tension between big economies. How might different administrations emerging from the election influence how the two economies and the markets behave? I think the key thing here to look at is labor policy. Labor policy in the US has really been to squeeze down wages, or allow wages to be squeezed down so that profits can grow. That has supported the stock market. In China, you've actually had a very pro-labor government that's been pushing up those wages that had been falling over the years, and that has been a headwind for corporate profits. So I would have thought that either through a tightening of the labor market or potentially a transfer of power in the US from the Republicans to the Democrats, which is still the most likely outcome, would see a switch in that dynamic. and you might see more pro-labor policies coming out in the US, and therefore creating much more of a headwind for corporate profits. Whereas in China, where you're likely to see a modest reflationary environment, you could see better corporate earnings growth. And so I think the relationship between the two in the financial world might flip around from what it's been in the last 10 years. You might see much stronger earnings performance and therefore market performance coming out of China. And to an extent, not completely, but to an extent, that will rely on the outcome of the US election.
This was Robert Horrocks from Mathis Asia. Thank you very much, Robert, for sharing your views and being with us today.
Thanks for the opportunity.